Hey, I'm Brian Briscoe with Streamline Capital here to talk about an amazing investment opportunity. It's a two-property portfolio in Salt Lake City. We refer to it as a South Salt Lake portfolio because it's in the city of South Salt Lake. But top to bottom, we're just real wave tops, 80 units between the two properties. They're about a mile and a quarter from each other, so close proximity. We're looking to give about 20% annualized returns to our investors, and that's what we're here to talk about today. So first thing we want to talk about is the management team who's in charge of this particular opportunity. Basically, I am the founder and CEO of Streamline Capital. Ultimately, I am responsible for how this investment opportunity works out. With me, we have Stephen Richards, who is our head of investor relations. And between the two of us, we're where the rubber meets the road. We are 100% in charge of making sure this investment opportunity works and is profitable for everybody. A little bit about me. I was born and raised here in Salt Lake City. Not very far from where we're standing right now is where I was born. Lived here until 2001. Shortly after 9/11, I decided to join the Marines, did a 20-year career with them. I started buying real estate in 2007. Got hooked, and over the years just kept on buying more and more real estate. Eventually got into multifamily, transitioned from single family to apartments in 2018. And to date, I've been in a general partnership of approximately 1,600 apartment units right now. Bachelor's and master's from University of Utah, which is just up the hill from where we're at. I did co-found a company called Four Oaks, headquartered in South Carolina. We ended up purchasing 9 properties, 600 and something units together in the Carolinas and Georgia. I left that company in 2022, shortly after I retired and moved back closer to home. And then founded Streamline Capital to basically do the same thing we were doing with Four Oaks. That's buy value add multifamily properties using the syndication model. So we are bringing in private capital, which is why I'm here talking right now. So far with Streamline Capital, we've acquired 3 properties. This South Salt Lake portfolio is 2 of the 3. Our average deal has given back 19% to investors, and that's annualized returns, 19% average annual returns to investors. Most of our deals have done better than we anticipated. Everything that we underwrite, 15% is the lowest. If we don't think we can get 15% returns, we're not doing a deal. Most of the deals we have exceeded the expectations. And what I really want to talk about, is not how well we did, but number one and the ones that didn't. This was our very first multifamily property, and what I'll say with that one is there's a reason that you shouldn't invest with somebody on their first multifamily deal. We did make some assumptions that weren't validated on this one, and we made some mistakes that we shouldn't have made, and we only made because we were inexperienced operators. End of the day, we still made money on that one. Incidentally, between the time of purchase and time of sale, we actually beat the S&P 500 with that 9% return. And this last one right here, if you're tracking what's happening in the market right now, July 2024 was probably not the most optimal time to sell it. But this particular property, our insurance almost doubled because of where it's at. It's in Augusta, Georgia. The insurance and property taxes went up enough that we were not making distributions. We were positive on our income. However, we asked our investors, we said, hey, this is where we're at. We are in no danger of foreclosing. We're going to be able to hold this property for many years. And we asked them, would you rather us sell, give you a small return on your money, or hold for longer? And the overwhelming decision from our investors was to sell, right? So looking at this one, all these other ones I think are just really good examples. We bought properties, we made them better. We looked for an opportune time to sell, and we sold them. So from here, we're going to talk about this specific deal, market overview, investment highlights, just what you see on the screen. Talk about the portfolio, give you an idea of where we're looking financially, and contact information at the end. So first, market overview, talk about Utah and then Salt Lake City in general. But the reason I want to start with Utah is about 80% of the population of the state of Utah is in the greater Salt Lake City area. So when we talk about Utah and the things that are happening in Utah, in most cases, we are talking specifically about the greater Salt Lake City area, or what we refer to locally as the Wasatch Front. U.S. News and World Report has for 2 years straight ranked Utah as the best state in the nation. Several different outlets have said, number 1 in economic outlet, best state to start a business, ranked number 3 in growth, best state for job opportunities. Now, this is an interesting one. 2 of the top 5 best performing cities. This study was actually updated, 2 weeks ago. Salt Lake City moved from number 4 to number 3. So, it moved up in the rankings in this one, and Ogden Clearfield, which is just north of Salt Lake City, is the new number 2 on this one. So Utah in general, the economic outlook is very bright, and there's a lot of growth happening in the state. So looking at top down, Utah as a state is performing very well, which is kind of like the wind in the sails of an investment opportunity. Now, as far as Salt Lake City, it's not a gigantic metro, but it's not small. We're sitting about at 1.2 million people in the Salt Lake Valley. When you add the entire Wasatch Front, that number's closer to 3 million. Median income is fairly high compared to the national average, which means that people can afford to pay the rents that we're charging, is what we really look at with median income. We're charging rents in ballpark of $1,500 to $1,800, and what that median income says is 70% of the population are going to be able to afford the rents we're charging. So we're going to have a very large pool of investors. Unemployment is historically one of the lowest in the nation. This is from a couple months back. And then median age, what really is important with the median age is Utah has the youngest population in the nation. So when you're looking at rental pools, we've got a very large pool of renters, and it's one of the has the highest birth rate in the nation most years. So we're replacing the population, and it is one of very few states where you take out inward migration, the state would still be growing. Okay, so really what I want to point out is we have a very healthy pool of renters, a very young population, and it's generally that 20 to 35-year-old crowd that is the bulk of the apartment renters. So with that population's forecasted to grow, which means we should have a very healthy renter population over the life of this investment. A couple things to point out, over here, Wall Street Journal, they ranked Utah's, right here it says specifically, the hottest job market. Salt Lake City was the country's hottest job market last year. And then this was the headline when U.S. News and World Report came out and ranked Utah at the top for the 2nd year in a row. Something else that I'm very happy to see, Winter Olympics will be coming back to Salt Lake. They came here in 2002. Once again in 2034, which brings a lot of attention to the state, and does nothing but help what's going on as well. This is one that we found, and I just like it because 17 years straight they've ranked Utah as the best state, best economic outlook. One of the monikers Utah has is Crossroads of the West, and that started because the transcontinental railroads that were built in the 1800s met just north of Salt Lake City, right? And so for many years, it was the crossroads. It was a stopover place for people going from east to west, before, cars, before highway systems. Utah was essentially that crossroads, whether going Oregon coast or California, people from East Coast and West Coast almost always stopped in Salt Lake City. And when you look at it, we have a couple of major freeways that are going through as well. We have I-80, which goes from San Francisco all the way to Philadelphia, I-70 and I-15 that all come together, within a couple miles of Salt Lake City, or within a short driving distance of Salt Lake City. Major international airport, they just put more than $1 billion into renovating the airport, and it went from a small international airport to a real hub. And then one thing, most of these reports point to is the infrastructure. Okay, Utah's infrastructure is top notch. And then something else, there's a lot of major employers in the area. And right now we're talking very specifically, here's where our properties are. Here's the downtown area. Sugar House is a very hot area right now to live and to work. But there's a lot of large companies and a lot of business that happens in this local area as well. So, which is going to continue to drive growth in the area. Education-wise, we got some major universities, and the Salt Lake-based ones are all very close to our this portfolio. I'm a Utah grad, and there was one day that I literally drove from the property to the campus. It's about 13 minutes. We are much closer to the community college in Westminster. And there's a lot of educational opportunities, and the point about that is twofold. Number one, a lot of students are renting apartments, and there's a lot of students in this area. And number two, good education boosts the economy as well. So, and most of the graduates of these schools are staying local and contributing to the local economy. Moving into the investment itself, it's a 2-property portfolio. On the left-hand side, you see White Pines Apartments, 56 units. And on the right, we have Blair Street, 24 units. One thing that drew me to putting these together as a portfolio is when you're managing properties, the larger properties are a little bit easier and more efficient to manage. Properties like Blair Street are a little bit more difficult to manage, but because these are both in close proximity to each other, we have a leasing agent and a full-time maintenance guy at White Pines, and they're managing both properties. So basically, we were able to wrap this together as a portfolio, 80 units together, and Blair Street really adds a lot of value to the portfolio by itself. So it just made sense. And as far as the management aspect, it's more efficient to run an 80-unit portfolio than a 56-unit property. We're getting professional management at slightly better pricing by putting these 2 properties together. From where these are located, you can get anywhere in the Salt Lake Valley in less than 20 minutes, assuming there's no traffic, because of how close you are to the freeway. So it's very conveniently located for somebody who's living there. And use my kids as an example. I've got a daughter living with her fiance, and they both work very far from each other, and being really close to an intersection like that lets them live there and be able to commute anywhere inside the valley. So very conveniently located. All right, some of the highlights. Purchase price on the properties, $17.4 million is what we paid for it. When we take the appraised values of both properties together, they were appraised at more than $18 million together. So we are walking in with a significant amount of equity. That doesn't happen a lot right now. I mean, a lot of times when you get the appraisals back, they're right at the purchase price, but there was enough here that the appraisers both came back with higher prices than our purchase price. So we're walking in with about $600,000 in equity. We want this to be a 5-year hold, and our total equity raise, we're looking for about $7.5 million, and we've already raised just over $5 million, looking for about a $2 million to finish the entire capital raise. As far as what we're giving to investors, we have 2 different opportunity or 2 different classes of shares for people to invest in. All right, our Class C shares, minimum investment is $250,000. We're going to offer an 8% preferred return with 80-20 split, which from the deals that I've seen, we intentionally put that above market average. Usually when you see an 8% preferred return, you're going to see a split that's weighted a lot more towards the general partnership team. But for our Class C investors, 8% preferred return, 80-20 split, which means you're going to be getting more of the returns. For our Class D shares, minimum investment 100,000, we're still giving really healthy splits. 6% preferred return, 75-25. That's in line with what market averages are. So Class C shares, you're going to get much better than market level splits. Class D shares, we're about average. Now, what does this look like for an investment? With the Class C investment, we're looking at about a 3x multiple. And one thing to note, we did underwrite the property out. We have two different models from 5 to 10 years. The 3x multiple is over 10 years. We are looking at a 2x multiple over the 5-year period. Our cash on cash return is about the same both directions. We're looking at about a 6% cash on cash return over the period, just north of a 20% annualized return, which puts our IRR right around 17%. And once again, Class C shares, minimum investment of $250,000 on this one. Our Class D shares, the numbers are a little bit lower. We do have a slightly lower pref, but still very healthy returns. We're just knocking on the door of a 20% annualized return and 15.9% internal rate of return. Now, something that we do is we look at the potential outcomes based on what market conditions are going to look like. All right. Right now, cap rates in Salt Lake City, cap rates are what really affect the pricing. Cap rates in Salt Lake City are between 5.1 and 5.25 for this type of property. All right. So we're underwriting this at a exit cap of 6%, which is quite a bit higher than it is right now. All right. And so if we can hit if we can hit that 6%, or even if cap rates expand to the point where that 6%, we're still going to be hitting a 15.9% IRR. Still going to have a decent equity multiple, and that's what we use in our underwriting. We're using that 6% exit cap. All right. If cap rates are a lot better than they are today, we're only going to do even better. And incidentally, just 2 years ago, things were trading on average at a 4 cap. We saw a lot of 3 cap properties trade, but I don't assume things are going to get back down to that level. But if they do, our numbers are pretty sick there. But like I said, right now, the market is at this tier right here. We are underwriting it at a 6 cap instead of a 5 cap. All right, sources and uses. Here's basically where the money's coming from. Where is it going? Okay, so 19.6 million is the total amount we need to do this project. Purchase price, acquisition fee. This is a fee that we are taking for the property. Closing costs go to other people. Financing costs and prepaid interest, that goes to the lenders. Capital improvement budget, we're putting just shy of $1 million in to make this property better. And then $80,000 that we're going to maintain in our operational reserves just in case, something happens. So, total sources, we're bringing in 19.6 million, and we plan on spending approximately 19.6 million. This is a 506C offering, minimum investment $100,000. Quarterly distributions, and as we'll show later on the financial slide, we do quarterly distributions. It'll probably take about a year once the renovations are complete for us to start with those actual distributions. All right, now we're going to talk about each one of these properties individually, and I will say that before wrapping these two together as a portfolio, we underwrote each property individually, and they're both from different sellers. So we didn't know if we were going to get both properties at once. So we made offers to both sellers at the same time, hoping we'd get them both under contract. But we were very careful to make sure that each one of the properties, by itself was a good investment in case we weren't able to close on both. Fortunately, we got both under contract, and we have already closed on both properties. And what we're raising is the CapEx budget from here and our acquisition fee as well. So that's the money that's continued to be raised at this point. So Both investments, stand alone. They're both good investments all by themselves. Together, there's a little bit of synergy that makes things even better. We bought this from a local company that does stuff similar to us. They do value add properties. They did an amazing job, but they didn't finish the renovations. The previous owner renovated all of the interiors, all 56 of the interiors, brand new LVP, new appliances, solid surface counters, new cabinetry, just absolutely beautiful job on the inside. On the exterior, they started the renovations, and because of the interest rate environment, they did have a bridge loan with a variable rate. Essentially, they ran out of money and couldn't complete their renovation. So we were able to pick this up at a really good price. My understanding is they did lose about $1 million on this transaction. So because of where we are in the market, we were able to pick this up at a really good price and essentially finish the renovation job that they had planned to do from the beginning. So one thing we have completed, every single one of the decks. We have refinished all the decks already. We have these entries to the lower level apartments. We've resurfaced the entire entries. We've also redone a lot of asphalt. Asphalt happens to be expensive, but we've done a lot of asphalt repairs and replacement. We've redone one of the roofs already, and we still have a lot of work that we want to do on the property. Like I said, we need some more money, raise a little bit more money to be able to do all the renovations that we want to do. But we were able to negotiate some of this from the lender to be able to do some of the, to start with some of the renovations already. In the future, we're going to do some more renovations. We are going to add some amenity packages. Looking to put in, off-leash dog park, playground, and pergola, potential gas barbecue, and some other exterior repairs as well to make things look even nicer than they already are. When we got this property under contract, they weren't charging pet rents, across the board. They weren't charging a lot of the other income items that are common in Salt Lake. We're not going to add extra things on that aren't, done in the rest of the market, but we have been able to already increase income by making sure that we are billing for the covered parking spaces, billing for storage. And we did already put up a new 28 storage units as of yesterday. We finished those, but we have been able to increase a lot of the fee income that is common in this area, and doing well and keeping the property occupied as well. So some pictures. This is one of the brand new decks already. We're putting the storage, or the brand new storage ones, and like I said, we just finished those yesterday, so we don't have the pictures yet. But you can see right along the back side of all these parking spots is where we put the storage units, so they have a parking spot with storage attached to it. And then interiors, this is what we inherited. Already looks amazing, but we were just able to do a little bit more to the exteriors. All right, and once again, some progress photos. Brand new decks across the board. We did a lot of work to the asphalt, which you can see down there. And this is what a lot of the decks looked like prior to. So I don't know why you'd put a carpet on an exterior surface in Utah, but that's what they had, and that's what it looks like right now. So we're doing a whole lot already. We just want to be able to finish the full renovation. Now, Blair Street Apartments is similar in vintage. This is a 70s build. We were at the property this morning, and we met a woman walking her dog, and it was really nice to talk with her because she said the exact same thing that we were feeling. We were just asking her, and I asked her the question: if you had a magic wand, would you change anything? And one thing she said is, the interiors look really nice. I'm really happy with the quality of the interiors, but the exterior is dated. And well, when you look at our value add plan on this one, we are focused mainly on the exterior because we feel exactly the same. The interiors looked great when we bought the property, and the exteriors were dated. Right here you see a representation of what we want this property to look like when we are done, and we have a picture of before and after here soon too. But one thing that we have already implemented, first of all, we bought this property from an individual that was managing a portfolio of roughly 60 units by himself. And so one of the things that we're going to be doing better is we are going to manage it professionally. The gentleman that owned the property, did very well, for what he was, but he is not a professional manager. So we're going to manage it professionally. And like I said, the management's going to be out of White Pines. So we have a leasing agent that's working 40 hours a week on this portfolio, and a maintenance guy also working 40 hours a week on the portfolio. But we've already put app-based payment system for the laundry. When we bought the property, there were 4 washers, 4 dryers with coin operated. Nobody carries quarters around anymore, but when we put the app-based payments in, we went from $1.25 a load to $3 a load for washing and $2 a load for drying. So looking at that, we should see a significant increase in our laundry income from what we had before. Number one, it's a lot more convenient to pay with an app, and number two, we are charging slightly more. The other thing that we noticed is, not being a professional manager, he wasn't charging the same types of other fees that are very, very common in the area. And Salt Lake City, for some reason or another, we tend to match what's happening in the market, but there's a tendency for apartment owners to add a lot of extra fees on top of base rent. And so just by implementing these same fees that he wasn't charging, we should be able to increase our income by about $3,000 to $5,000 annually. And same thing, he wasn't charging for parking or the storage on site. So a lot of what we're doing on this property, we can just flip a switch and start charging people for things that the previous owner wasn't charging them for. And his base rents were low across the board, so we should be able to do that pretty seamlessly. Now, this is what it looks like right now. Old and dated, mansard roofs with the shingles on the outside. And this is what we are going to make it look like before we're done. So real nice, fresh look on the exterior. We're going to take a building that looks like it's from the 70s, and it literally is, and make it look like something that's modern and looks new. Now, like I said, the insides already are in really good condition. When we bought the property, our first instinct was let's renovate everything. Let's renovate interiors and exteriors. But when we went through the property, we realized that the interiors were in very, very good condition. And we didn't see a lot of value to come in with, $15,000 on the interiors when we already had, really good conditioned units. So we decided to leave the units as is, and then as we are turning, as people move out, we are replacing flooring as needed and counters as needed. It doesn't happen frequently, but because of the condition of the interiors, there wasn't a lot of bang for the buck in doing a full interior renovation. So once again, most of the renovations are going to be exterior on this particular property. Now, how has it gone so far? Well, we've been very fortunate to be able to keep occupancy very high on both of these properties. As of this morning, we are at 100% occupancy on both properties. But since we purchased the property, we've been sitting, we've averaged about 95% occupancy, all right? We were projecting occupancy in the low 90s. Salt Lake City market average is about 94%. So we are doing slightly better than average as far as maintaining our occupancy. Our collections have been fairly high. We're doing well in our collections. We are about on track with what we underwrote for our collections up until now. Of course, it's not, when you look at our real numbers, we have up months and down months. We've had a couple months lower collections and projections, and a couple months where we've had higher, but we're on track with our projections on both properties as far as our increases in income. Let's look a little bit at our debt. Blair Street Apartments, since we weren't going to be doing, a full renovation, we did look at a couple different loan products, and we decided to do a 5-year Freddie Mac. One thing that's really, really nice is we did get a 5.25% fixed rate on that Freddie Mac loan. Now, one thing that we want is we wanted to build in a little bit of flexibility on the exit. And so we have a prepayment schedule. Normally on a Freddie Mac loan, um, you're going to get a 5, 4, 3, 2, 1 pay down. This is your prepayment penalty. So if you sell it in the first year, that first number is your prepayment penalty. So we actually gave them a little bit higher interest rate than we could have to get a better prepayment schedule. So if rates come down in the next month or the next year or two, we will save money by refinancing because we'll have a lower prepayment penalty. So there's a little bit of, we did pay a little bit more for flexibility. We could have got probably as low as a 5.2 on our interest rate, but we decided that it would be better to have flexibility on the back end. So if rates come down to a lower point and we want to do a cash out refinance, it'll be cheaper for us to do it. We do have 3 years of interest only, which is really nice, helps out on the cash flow. And something else to note is we do have a very low loan to value, and generally that's perceived as being a very, very safe loan. So 63% LTV, 5.25% fixed, 3 years, interest only on the term. White Pines, we decided to do a bridge loan on this property. It has a little bit higher of an interest rate. And what we're trying to do with this particular property is get the renovations done and refinance the property. So we do have a bridge loan. It's a 2-year loan with a 1-year extension. The advantage of the bridge loan is we were able to get more proceeds. On this particular property, if we were to go with a conventional loan, they were only going to give us, about $7 million in proceeds. We were able to get just over $9 million in proceeds. So the leverage, we're still under 70% leverage, which means it's still fairly safe. Our interest rate is higher. We do have a 9% interest rate. No prepayment penalty at all. So what the goal is to get in and get the renovations finished as soon as possible, refinance out of this loan into a loan that looks more like this, targeting a Freddie Mac loan on the back end. So that's the business plan here. There's a little bit more risk, and I know a lot of people are very sensitive with debt right now. There's a little bit more of a risk with bridge loans and variable rates, but we do have a rate cap. We have rate cap insurance at 9.5. Our interest rate floor is at 9. And where interest rates are right now, the current rate is below our current interest rate floor. So for all intents and purposes, we have a fixed rate of 9% over this term. Okay, so once again, we're looking to refinance out. And right now, with where rates are today, we're not going to get a 5.25% loan today. Freddie Mac right now pricing on this particular property would be about a 6.25, which means we're going to be able to refinance out of this. All right, so looking at financing, we're going to talk about Blair Street first and the White Pines financing. 2 separate properties, 2 separate loans. So with Blair Street, on both properties, we looked at a variety of different loan types. We looked at agency loans, we looked at CMBS products, and we looked at bridge debt, for both of these properties. And what we decided on Blair Street was a permanent loan, 5-year term. It is a Freddie Mac small balance loan, so agency debt. And one thing that we feel really strongly about is we want to have a very flexible exit, okay? We're in an environment where a lot of people are expecting rates to come down or some relief in rates over the next 2 years. And we want to be able to take advantage of that if they do come down. But on the flip side, if they don't, we still want to make sure that we're okay. But we opted for loans that give us a little bit more flexibility without adding too much extra risk. So on this particular one, we had a $4.5 million purchase price, $2.8 million loan. We're at about 63% LTV, which is a very, very healthy number. We were able to lock at probably the most opportune time in 2024 and got a 5.25 fixed interest rate. Prepayments, and this is one place where we did a little bit of negotiation to get a more flexible prepay. normal prepayment schedule on a Freddie Mac loan would be a 5-4-3-2-1, which means 5% prepayment penalty the first year. If you refinance or sell, 4%. So we have a reduced prepayment penalty on this one. So if we sell during year 2, we'd have a 2% prepayment penalty instead of a 4% prepayment penalty. So if rates come down to a point and values go up to a point to where it makes sense to refinance, we're going to have less of a sting on the back end. All right. And then interest only period, 3 years. We are only paying the interest. It's not amortizing for the first 3 years, which definitely helps a lot with our cash flow, especially since we bought this property with every single lease under market rent. It's going to take us some time to bring those up to market. So that interest only period helps us out with the cash flow during that period. All right. So Blair Street apartment, out of the 3 choices, we decided to go with agency. It just made the most sense for this one. Now, White Pines Apartments on this particular property, we also looked agency, we looked CMBS, and we looked bridge. And on this one, we selected a bridge loan. Looking at the differences, a CMBS was our major, the big decision was between this one and a CMBS product. But this one ended up giving us a cheaper loan overall. The CMBS had a very, very hefty prepayment penalty. And once again, I did want to lean towards flexibility on this one to be able to take advantage of interest rates, as they come down. They've already come down quite a bit off the rate that we're paying right now. But if the longer term rates come down, we should be able, we want to be able to take advantage of that one. And then with the agency and the CMBS loans, those were 5-year terms plus. So we decided to get a bridge loan with a 2-year with an extension out to the 3rd year term. Now, with our loan to value ratio, we're still at 70%, which is a really, really good number. And incidentally, that's 70% based off of the purchase price, which was $12.9 million. The appraisal came back at $13.3 million. So we have another $400,000 in equity. The biggest risk with the bridge loans is being able to hit that refinance. But what we did to mitigate the risk is we did come in with a lower loan to value. We do have an extra $400,000 in appraised value or in equity in the property. So looking at this one between the other loans, even though we're at a 9% interest rate, when you looked at all the fees associated with the CMBS product, we're actually going to pay a lot less in total interest between a 2-year bridge loan refinancing into a permanent than we would have on a CMBS loan. So that's the loan we chose. Once again, 70% leverage, which is a safe number. Not super excited about that interest rate, but comparing that with total interest paid on the CMBS loan, we actually come out far ahead with this particular loan. All right, so now we talked about each one of these individually, but now let's look at this together as a portfolio because it is a portfolio. One other thing with risk mitigation is we do have 2 properties here. Okay, so I know a lot of people are very hesitant on bridge loans right now because people have been burned recently on bridge loans that were taken out in 2021 and 22. We are in a much different environment right now where rates are more likely to go down than they are to go up in the next 2 years. But even that said, we now have 2 properties in the portfolio that we have as chess pieces on the board, okay? So what is the worst case scenario in my mind? Worst case scenario to me is, getting towards the end of that term and not being able to do a successful refinance. This is where the advantage of a portfolio comes in, all right? Blair Street Apartments appraised at about $300,000 over its purchase price as well. And, we have a very, very good loan on it and a lot of potential in this property to raise the value very quickly because of the lack of professional management on this property. So one thing that we could potentially do to make refinance on this one work is to also refinance Blair Street at the same time with a 63% LTV. we're much more likely to be able to do a cash out refinance on Blair Street. And if for some reason we're not able to refinance out of this loan in that term, we do have another chess piece on the table that we can use to potentially do that. Now, the most likely scenario, we don't need that much of an increase in our purchase, in our value, and we can refinance where rates are today and be really close to a successful refinance on this one. So within the next 2 years, we calculate we have to add about $600,000 in value to this to be able to have a successful refinance. And I don't see a ton of risk there, but once again, second chess piece on the board that we could leverage if there's ever any problems with a refinance on White Pines. Now, projected returns, we did map this out to 10 years. We want to be able to sell or refinance at year 5, but we did it out to 10 to answer the question, what if? We had a lot of what if questions. What if the market hasn't fully recovered at 5 years? Well, if the market hasn't fully recovered in 5 years, the answer is we hold, and we hold till 10. All right. Typically with real estate, we are probably at the bottom. We've been in a downturn for the last 2 years, and I think we're at the bottom. A lot of the think tanks that make projections on real estate say that we should have several years of increases coming up. But what if we don't? We have a new president, new policy, a lot of new stuff happening right now. What if it doesn't? We just hold for a longer period of time, okay? But looking at what we expect to give, and this is based on a $250,000 investment for Class C shares, year 1 on value adds are usually very thin, okay? We're projecting about 1.5%, cash on cash for the first year, okay? Year 2, the cash flow from operations is going to be comparable to year 1. We are projecting a successful refinance though, and with that successful refinance, we should be able to do a cash out and return some of the investor capital at year 2. Once we refinance into a lower interest rate loan, we should be able to open the doors quite a bit on the cash flow, and we should be hitting mid-single digit returns just from the cash flows for years 3, 4. And then the goal, once again, is to sell at year 5, but we could potentially refinance and hold the portfolio for longer at that point, okay? If we do go out to 10 years, our cash flow only gets better. Incidentally, there's a dip between year 7 and 8 because we project if we do refinance, we're projecting another 3-year interest-only term. But as far as that goes, our projected multiple over that 10-year period is a 3.1, IRR 16.6. Holding out to the 5-year period, our IRR is slightly higher, and our multiple is closer to 2. And something to note, if you are watching this, you are probably aware of PREIshare and the ability to liquidate shares through their platform. We are an approved sponsor on their platform. So if you have every intention of selling at year 5 and we decide to go to year 10, not likely, but it's a possibility, you could potentially use the PREIshare service to liquidate your shares, and we will fully cooperate with that. I won't spend as much time on this slide explaining things, but this slide right here is for Class D shares based on a $100,000 investment. You're going to see similar trends, very low cash flow year 1 because we're focusing on the renovations, we're focusing on raising the rents, raising the income, and making management more efficient. Year 2, the cash flow from operations is going to be approximately the same as year 1, but with that refinance, we should be able to return a good chunk of your original investment back. And then the numbers start getting better as far as your expected quarterly returns. And same thing, we are expecting to sell year 5. But the what if we have to get to year 10, we have a lot of maneuver room in this property to be able to do so. Okay, now diving into the financials here, and just full disclosure, I'm not gonna, there's a lot of small numbers on a screen, lots of numbers on a screen, so we're not gonna go into a lot of details here. If you're a numbers person, you wanna do a deep dive on our numbers, set up a call with us, email us, we will share everything. The next two slides have individual breakdowns of White Pines and Blair Street. So you'll have our P&L at least, but if you want to do a deep dive or have questions about the numbers, feel free to reach out. Okay. So one thing that I do want to point out is our effective gross income year one. We're looking at about 1.1 million is what we're expecting. The previous owner on their T12 was just shy of $1 million. And we are doing some very modest increases in income across the board. 1.1 to 1.2, 1.2 to 1.26. So we think our numbers on our increases over the years are very conservative. Salt Lake City has seen very high rent growth in the past. There's a very pronounced shortage in Salt Lake City, so the projected rent growth in Salt Lake is actually a lot higher than what we have projected here. Okay, so these are very conservative numbers looking at our income going forward. And then same thing for Blair Street, very conservative compared to where we were, where the previous owner was, and how much meat's on the bone on Blair Street. We think our projections on income are very conservative across time. Expense ratio in Salt Lake City on multifamily averages out to be about 30%. So if you're used to seeing multifamily deals in other markets, this is one thing that you might trip up on. But Salt Lake City, all the lenders agree, 30% is the expense ratio in Salt Lake City. And quite honestly, a lot of that has to do with the fact that property taxes aren't sky high, and neither are insurance rates. We have some of the best insurance rates in the nation and fairly low property taxes. So our total operating expenses were right around 30% throughout our portfolio. A little bit more of a deep dive here. Where we see a lot of our income increases on White Pines is burning off loss to lease. And what loss to lease is it's the difference in market rent and what we're actually charging, okay? And then we were always building in a very healthy, vacancy loss, we're always going to have vacant units. We're always going to have people moving out. As we mentioned before, our occupancy rate is pretty high. We had one move in today that brought us up to 100%. And we have one move out at the end of the month. So we're really, really healthy as far as our projections and tracking these numbers right here. We are looking at year-over-year increases on these properties, our insurance and our property taxes. We're expecting everything to go up. So looking overall, our net operating income is going to grow over the years. But once again, we think our income numbers are very, very conservative. Blair Street, same thing. Interestingly, we have a lot higher loss to lease because of the lack of professional management there. So we should see a lot of our increases in our income come from bringing rents up from where they are right now to the market rates. Of course, we'll be doing some renovations, so we'll be able to push rents with those as well. Same thing, we have a very healthy number in here for our vacancy rates. And then same thing, we're planning on all of our expenses increasing over time because that's what they do. So, bottom line's right down here. And, next slide, we're going to move into how that works out for you with your numbers. So from here, if you have any questions, if you want to discuss this further, my name, my cell phone number, my email address, there's Stephen, cell phone number, email address. Reach out to us, get on a call with us, and we'll walk you through. We do have a QR code right here with a link to our investor portal. We have a lot more information on the investor portal. We have our legal documents. We have this full pitch deck, a lot more pictures. But if you're looking at more of a deep dive on anything that we showed today, we also have another presentation of the same webinar, link there. This is where you want to go. Scan the QR code with your phone, and that'll take you to our investor portal. If you don't have your phone available right now, streamlinecapital.investnext.com. If you are ready to invest or you want to invest, this portal is also the place to do it. So this is where you go for more information. This is where you go if you're ready to invest.